Good afternoon, everybody. I'm Jack Hogoboom, and that's the Hall of Famer, Chris DeFalco. Isn't that what Joe Buck says every time he introduces Troy Aikman? So we're here to talk about regulatory limitations that affect smaller cap companies looking to raise capital. Chris, why don't you go ahead and start with a market overview?
Yeah, absolutely. Thanks, everyone, for joining. My name is Chris DeFalco. I'm Managing Director in the Equity Capital Markets Group at Oppenheimer. I've been focused on small microcap companies for the greater part of the last 10 years. I've done over 275 book-run transactions, and some of the things we're going to be speaking about today really are what I would say imperative as you look at smaller and microcap companies in terms of preparation and ability to access the capital markets. Traditionally, in ECM, you hear folks talk about different windows that are available. Usually, the IPO window is an important characteristic of the access to specific companies. For microcap companies, it's even more selective. You need to be more prepared. And we wanted to start this conversation off with a few slides, just looking at the market as a whole to try to put a little more emphasis on the regulatory attributes and where you should be focused as either a corporate or market advisor. So in the top piece of this slide, you'll see just overall performance over 2023. And if everyone looks at their PAs and they've seen a lot of the larger indexes up for most of the year, but if you kind of bifurcate that out from the top 10 market cap companies in the S&P and NASDAQ, performance has been quite limited. So when you look at microcap and small cap companies, there's actually been a little bit of a grind. New issue market has been down quite significantly, and really the ability to access the capital markets has been challenging. Go to the next slide. I think this will also highlight some of those qualities. If you look at the top chart, you'll see that green line represents the Goldman Sachs unprofitable tech index, which we use as an indicator for small and microcap companies. And you can see it's underperformed significantly relative to the broader markets. And then the bottom left, you'll see an increase in NASDAQ and NYC listed companies that are trading under $1 over the course of the last 5 years. It's jumped significantly. I think you can attribute that to 2020 and 2021 in the significant rise of SPAC IPOs and traditional IPOs. That's why you see that number jump up close to 500. And then on the last bar chart, which I think is quite interesting, is if you look at the capital raising statistics among different market caps, the percentages of the capital has remained quite constant over the course of the last 6 years, but the number of transactions are down, and as you can see, there are more companies within that small and microcap bucket. So there's less proceeds, but more companies fighting over that, which means you really have to be selective. You need to match up the timing of some of these offerings with a lot of what's happening with your company, whether it's positive news, whether it's quarterly earnings, things that can help drive the stock, bring liquidity and excitement, and provide a roadmap for new investors to participate.
So the world in which the smaller cap companies have to operate is even more hazardous than the general markets, and the SEC and the exchanges in their infinite wisdom have adopted a set of rules that, for all intents and purposes, really penalize smaller capital companies that are looking to raise money. One of the ones that everybody should be familiar with is what we lovingly refer to as the baby shelf rule, which is a provision in the Form S3, which is the form that people use to register shelf registrations that limits the amount of securities that a company with a public float of less than 75 million can sell to a third of their market cap in any 12-month period. This rule has a lot of unintended consequences, not the least of which is that if you are trying to do a deal in this space, you're often doing structured transactions with warrants. The problem is that warrants have a significant negative impact on the amount that's available to be sold under the baby shelf rule without providing liquidity to companies or capital to companies. And so there's lots of things that people have done over the course of time to try to avoid those concerns, one of which is trying to pair a public offering of shares under a shelf with a simultaneous private placement of warrants that's outside the shelf. For years, there was some concern about whether that actually worked from a legal perspective and what the SEC might have to say about it. And curiously, the SEC finally weighed in a few years ago and said, we think doing a transaction like that's an evasion of the baby shelf rule, but rather than prohibit it, what they did was they said, if you do this, then we're going to make you register the warrant shares for resale on an S1 instead of an S3, which is a small price to pay for being able to use the structure. So I'm sure, Chris, you probably see lots of this in your structuring discussions in terms of how to try to maximize proceeds under baby shelf.
Yeah, absolutely. I think the takeaway here is the baby shelf rule is quite limiting for companies that need to access capital. Most small cap, micro cap companies need to raise growth capital in order to run their business. So if you are any company that is sub 200 million in equity market value, you need to be aware of the baby shelf rule. There are two primary calculation dates that are important when you file a new S3 shelf registration statement or your annual 10K filing. So although you may not be baby shelf limited today, that could be the case coming up on your next 10K, and you want to address it ahead of that and put certain either structures or concepts in. I think one example that I hear a lot from some of our small cap clients is they may be going into baby shelf or the calculation may show that they may be limited going into the next year. And ATMs are a very popular financing vehicle for small cap companies. And one nuance about the baby shelf rule is if you file your ATM ahead of being deemed baby shelf limited, you can file as large of an ATM as you'd like. But then once you fall into the restriction of the baby shelf, you will be limited in the number of proceeds you'll be able to raise based on the 1/3 calculation. Whereas if you do not file the ATM ahead of falling into the baby shelf limitation and you file your ATM subsequently, the largest amount of that ATM face size would be whatever your baby shelf calculation is. So for example, if you are a 100 million market cap company that has a public float of only 60 million, the baby shelf limitation would only allow for you to raise $20 million, 1/3 of your public float, over a rolling 12-month period. So in the case where you would file the ATM prior to being baby shelf limited, you can file as large as an ATM as you'd like, and then over the course of the 12-month period in which you are restricted, you'd be able to raise 20 million. Now, if your stock price goes up and your equity market value goes up to, let's say, 200 million, right, that would double your capacity at which you'd be able to raise on the ATM. If you look at the latter example, you would only have been able to file an ATM with a $20 million face amount, which was that 1/3 of the 60 million public float. And even if your share price were to increase, you'd be limited to only raising the 20 because that is what you had registered. So there's little things like this that provide more financing flexibility. And as an equity capital markets banker focused on small and micro cap companies, everything I am focused on for corporate clients is financing flexibility. And if you're in a position of strength, even better. But I believe it's my job, and your job as well, representing corporate clients, is can you set the company up to be successful and be able to pull a lever if they need, at a specific time.
Yeah, and it's important to understand what the effect is. So, every time you're making a sale under an ATM agreement, you're basically increasing your public float because those shares are held in public hands, and so you can basically buy more capacity under the baby shelf by making sales under an ATM program. So it's a good idea for small cap companies to have an ATM program, even though most investors absolutely hate them. The other thing I just want to say about this is, you could do, you could avoid baby shelf by trying to file an S1, which is the normal registration statement, and then waiting for the SEC to clear it and then have it declared effective. But most smaller public companies don't like to do that because you're out there with a registration statement, and the world knows that you're contemplating making an offering, and that can put significant downward pressure on your stock price. Not to mention the fact that it's not as easy to take advantage of potentially market-changing news about the company. So while that's a possibility, a lot of companies prefer to have financings done off of a shelf registration statement because they can basically, and I don't know how appropriately, but it happens all the time, sort of time the sale of their securities so that they're coming on the heels of good news about the company.
That's certainly advantageous. One last point on that, I think it's important. The difference between an S1 and S3, I mean, we can do a whole conversation on that, but what's most important probably to this group is preserving your share price during the marketing period and being able to utilize an S3 to market confidentially before pricing is a huge advantage. And when you think of the cost of capital and where the dilution comes in, you want to try to have the highest reference price possible and mitigate any dilution and discount that would be provided on that capital raise.
Right. So the exchanges have done their own bit to make life difficult for smaller companies. Both the New York Stock Exchange and NASDAQ have rules that, in essence, would limit a listed company's ability to raise capital at a price below what they deem to be the market price to 20% of the pre-deal shares outstanding. And that can have obviously a very limiting impact on a company's ability to raise money. A lot of times people try to get around this by coupling a common stock offering with warrants and delaying the exercise of the warrants by 6 months, which NASDAQ has opined takes it out of the 20% limitation because it's not deemed to be happening at the same time. It's important to know that the NASDAQ official closing price is not what you see on Bloomberg or Yahoo Finance or whatever. You have to go actually on the NASDAQ website to find that price, and it can often be off a little bit from what you think the closing bid price might be.
Yeah, I think to be more direct, any company is limited to selling or would require shareholder approval if they wanted to sell over 20% of their shares outstanding in a private offering. So when considering, what your market cap is, and if you have the intentions to raise something larger, you're either going to have to conduct a public offering or you're going to have to structure around some of these, exchange listing requirements. The NASDAQ 20% rule, will also cover the NYSE 20% rule. They're pretty similar with each other. There are some slight differences. I think the main takeaway I would say is you can structure around these effectively, much more effectively than the baby shelf, in my opinion. And you can utilize certain convertibles. You mentioned warrants struck at a premium.
Yep.
Stock struck at a premium. So I think as you're considering your financing options and as you're considering what is the best execution to raise the capital, you need to be aware of some of these limitations because even the investor groups at which you look to attract, they need to understand why the pricing is coming during these levels and why we're structuring certain things. So it's important to know ahead of time before you're ready to raise capital.
So one of the things that I think at least we spend a tremendous amount of time on, I'm sure you must as well, is trying to structure offerings so that they're treated as quote-unquote public offerings under NASDAQ rules, because a public offering is not subject to the 20% test. And the NASDAQ has a wealth of interpretations and views on what qualifies as a public offering. The problem is that they're not always consistent, and people might hear or think they know things, and all of a sudden something becomes a market practice when it's not really sanctioned by NASDAQ. So I know a couple of the things that are really important is that in the typical public offering context, you're not allowed to have somebody buy more than a third of the deal. And in the last 6 months, that concept got really pushed to the limit, where there were transactions involving one investor buying up 90% or more of an offering, and people were taking the view that those were good public offerings under NASDAQ because they had done them before. And NASDAQ also changed their process for reviewing listing applications so that they weren't providing pre-offering guidance now. They were reviewing things after the fact, so there was kind of a lag effect in terms of NASDAQ's looking at these deals. We're aware in our firm of 3 separate issuers who have received letters from NASDAQ either saying basically your deal was not a public offering, or basically saying we don't think it was a public offering, demonstrate to us why you think it is a public offering.
None of those were Oppenheimer deals, by the way.
Well, that's not for lack of trying. That's because of you, not because of me.
No, I don't know about that.
But I guess the point is that companies got very desperate late in 2023, and when you're balancing compliance with NASDAQ rules with the fact that you're going to die on the vine and not be able to pay your employees and suppliers if you don't raise money, people are more willing to cross the line and do things that their counsel or others are basically saying, look, you're taking on huge risks. So it's important to know. The other thing about this is that for something to qualify as a public offering, typically it can't have a discount of more than 50% from the quote-unquote market price, and there's all kinds of ways in which that discount gets calculated. In the case of a transaction with warrants, NASDAQ arbitrarily attributes a value of 100% warrant coverage as an eighth of a point or 0.125 in purchase price. And for a company that's trading at a relatively low price, and Chris's slide showed how there are over 400 companies that were trading below $1, that becomes a significant premium, which makes life kind of difficult, and so it just gets to be very difficult to structure. I want to leave some time for Q&A. So as Chris mentioned, the New York Stock Exchange has its own rule. It's very similar. The NYSE doesn't have the wealth of interpretive material that NASDAQ does, and so it's a little bit more difficult to figure out what works for them, but they're by conversely much more willing to talk about it in advance. And the important thing is if you do a transaction with warrants, unlike NASDAQ, the New York Stock Exchange will actually require you to do a Black-Scholes valuation of the warrants, which, depending on the circumstances, could actually be good or bad. We actually had a couple situations where it turned out to be good because the Black-Scholes value was less than 12.5 cents. So I don't know if you want to make any comments about that particularly, or...
I think ultimately, especially when considering microcap companies and when you consider stocks below $1, that 12.5 cents remains constant. So 12.5 cents is actually a larger discount relative to your share price, right? Whereas if you're working with a company that has a $10 stock, and if you're going to do a 10% discount of $1, you know, having a 12.5 cents attribution for the warrant, it doesn't hurt as much. But if your stock's at 50 cents and you're selling at 45 cents, 12.5 cents is pretty meaningful. So the main theme of this conversation is all of these can be worked through. And I think the key word of, the title was navigating, right? How do you look ahead, 6 months, 18 months, understand when you're going to potentially need to raise capital, and just make sure you're checking the box and thinking about all these different, restrictions and limitations to make sure you're properly equipped.
We have exactly 30 seconds left for Q&A, so does anybody have any questions out there? I'm sorry? Oh, fine. So we can filibuster then? I didn't know. I didn't realize that was an option. I mean, these are very complicated rules, so I'm sure most of the issuers that are, if there are any issuers out there, have had to come to grips with these one time or another. So I don't know if anybody has any specific questions. If not, we can stick around for a little while after we're done. We didn't put anybody to sleep. I don't see anybody slumped over, so. All right, I guess we'll turn the stage over to the next group. Thank you all very much.
Thank you, everyone.